Michael Burry is a prime example of survivorship bias, and timing the market is fake. Or is it not? In the next 10 minutes, we'll explore the trades that made guys like George Soros or Paul Tudor Jones famous. Now, there are three main strategies for mega successful trades, and there is something you can actually use to make your investment more profitable. Now, a month ago, all newspapers reported Michael Burry betting $1.6 billion on a market crash. That's 93% of his fund size. So why did he take so much risk? Well, actually, the truth is quite different. Now, though these sensationalist headlines appear from time to time, have a look at the SPY total options exposure. Currently, it's around 21.26 million contracts. Now, it's important to understand the value of those. Newspapers usually operate with notional volume. It makes bigger headlines. But the truth is, it's only relevant when the options are executed. Each option contract gives the holder the right to buy 100 stocks. So for SPY open interest, we're talking about 2.1 billion shares of the ETF. Now, these shares are multiplied by the current market price of $447. Now, that leads us to a giant number of $950 billion, almost $1 trillion. But the truth is that it's just on paper. In reality, traders would only actually process the premiums for those contracts, which would be around $15 billion in today's market. So, how big was Burry's bet really? Well, actually, it was only around $20 million in premiums. Now, that's merely a hedge, though it covers his whole portfolio. But that wouldn't make a headline. Before we uncover the three strategies of the most successful trades in history, I'd like to announce that next week we'll have a massive dive into Apple and the real difference between growth and value companies. So please subscribe not to miss it. Now, there are quite a few Burrys out there. Take a closer look at the exposure. Burry made a trade of 0.1% of the market size, while the biggest holders of positions are market makers like Citadel and professional hedgers and speculators like Morgan Stanley and Goldman Sachs. These guys have the best trading intelligence in the world. And not only do they analyze all the available data, paying millions of dollars to data vendors, they also talk to people. Yeah, it's like the Stone Age method, but it gives you more insights than all the data combined. There's a nervous CFO, a CEO stuck in some African country for seemingly no reason, a set of meetings between rival companies. Now, all this can lead to some almost inside knowledge. And this is how some of the most incredible trades have worked in the past. Now, the first type of outstanding trades is what I call the deep research trades. Now, they're usually targeting a specific company. Now, the prime example is the Enron short performed by Jim Chanos. Now, so he was gathering information about the company for more than a year, studying their accountancy practices and business environment. So finally, he discovered some red flags that allowed him to form his short position before the scandal broke out in 2001. The stock's price went down from $90 to less than $1, and eventually the company went bankrupt. Now, this level of commitment, hard work, and access to data is very hard to achieve for regular guys like you and me. Oh, and you need capital and the ability to stomach incredible losses. Most traders with this approach can sit out at 50 to 70% loss on their trade worth tens of millions of dollars until their idea works. But the intel behind it has to be impeccable, verified by multiple sources, and as solid as a rock. So the second type of incredible trades is what are called the activist trades. Now, this means that traders actually take action, not just sit and wait. Carl Icahn is the most famous example of somebody buying a minority share and then attacking the management, other shareholders via media or corporate procedures. He would destroy or save companies at will. Now, because of the great narrative, people forget that Warren Buffett is actually this type of trader too. He didn't make his fortune by sitting and waiting for good companies to grow. He actually took over Berkshire Hathaway as a cotton producer and helped the company prosper. He owned the majority of it, but even his later trades all had a second bottom. Now, let me tell you about how he saved Goldman Sachs in 2008. So he invested $5 billion in Goldman Sachs, and he made it very publicly. Everybody felt relieved and followed him. But the trade actually had extra conditions, like a warrant that ensured Goldman would return this investment at a fixed price with some upside should Buffett choose to trigger it. There was no downside for him. He was safe because the bank could use the client's money for this transaction. Buffett saved the bank, but people only talk about how he saw opportunity. It was more than that. He created it. He's less aggressive than Icahn and talks about a small part of his success, so the image is completely wrong. And finally, something you can benefit from, the counter-trend traders. Now, these guys see fundamental imbalances and are able to predict when they will end up with a crash. George Soros knew the sterling pound was vulnerable. Michael Burry saw the flaws of the subprime mortgages. And by the way, he wasn't the only one. John Paulson made a fortune on CDOs in 2008. Kyle Bass saw it too and shorted the mortgage-based securities. Now, you can already see a pattern. Quite a few people made money on counter trends. So, what are they looking at? How do they time the market, and how do we identify these trades? So basically, these guys look at the publicly available data and use common sense. Now, I bet their main thought is, this isn't right, or this doesn't make sense. For example, how can rising loan delinquencies coexist with a strong consumer? Then the matter comes in, how fast does the trend unravel? Now, some indicators like GDP take multiple quarters to change the trend. When is the point of no return? What are the odds? What can happen to overturn the trend? What are the most volatile elements of the system to plan the trade? Well, having worked those out, the counter-trend traders have a clear indication of what they want to do. Timing is the final piece. Some of those trends take a couple of years to turn around, so options might be quite an expensive bet. Now, the problem with options is theta. Now, that is the speed of an options contract losing value. It's accelerating over time, so the closer to expiration date, the faster the contract loses value. Option trades require clear understanding of the timing. That's why we find so much inspiration and multiple insights watching the flows of institutional trades in our models. Now, here's an example of a short-term setup. October 20th expiration shows a strong belief the broad market ETF SPY cannot go above $450, but is likely to stay above $420. And here is December 2024. Usually, more distant expiration trades are bets from larger institutions and are less speculative. So you can see that 15 months from now, one of the biggest bets is that SPY will go down to $400. And the second biggest is it will even go lower to $350. At the same time, bullish $560 bets witness a lack of confidence, decreasing by 10%. Now, you remember the big guys running this market? They are clearly waiting for something. So should you. Use the link in the pinned comment to check out NASDAQ ETF. The ticker is QQQ. Visual sectors is the perfect answer to the win question. We help retail investors understand key trends in the market, and our data sets put a calendar date on them. We source the most complicated data from Standard & Poor's, FactSet, and Options Pricing Reporting Authority to turn them into easy-to-read charts with up to 72% win rate based on 10-year back test.